Great. Hello, everybody. Good morning, good afternoon, good evening, wherever you are. Thanks again, Michelle, for the kind introduction. We are in the education business, and at Leasecake, it's important to share stories, ideas, advice across the industry, and we encourage your questions during the session. We don't need to necessarily wait. It's just fun that way, and it becomes more interactive, and we learn a lot faster. So my name is Taj Adhav. I'm the founder of Leasecake. And we are coming at you from Louisville, Kentucky. And that's where we are. And I feel like there should be a bottle of bourbon behind me. But we've got this roaming studio. So wherever we are, we believe that it's important to share stories that need to be heard. And in that spirit, I'd like to welcome our illustrious guest today. Yes, a five-time CFO, incredible history working in the restaurant, specialty retail, health and wellness segments across so many business functions. He's seen all sides of business, including M&A and private equity. He's got tons of nuggets to share today. Please welcome the Chief Financial Officer of EWC Growth Partners, Spencer Manke. Spencer, welcome.
Thanks, Tosh. Pleasure being here. Looking forward to having our conversation.
Absolutely. All right. So I think we're going to have to go way back in the time machine because you got into finance how? Why don't you start with,
Sure.
your career journey? How'd you get started and take it from there?
Yeah, when I was in college, I thought I wanted to be a public accountant, so I got my degree in accounting, but also finance. And my first job right out of college was working for Coopers and Lybrand, which at the time was one of the big six public accounting firms. And when I started there, Coopers had actually just created their financial advisory services group, which was designed to compete with Anderson Consulting. And so while at Coopers, I spent the busy season, January through May, working on the audit side, working towards getting my CPA. And then the rest of the year, I worked in their consulting group and specifically in their valuation group. And one of our clients was a lender out of Boise, Idaho, that was making loans to, at the time, QSR franchisees. So KFC, Taco Bell, Pizza Hut. And they were pooling these loans and securitizing the pool. So they were using the commercial mortgage-backed securities model to pool these business loans and then sell securities that were backed by these loans. And so that's really was my first introduction into franchising. Never really thought much about franchising, even though obviously I frequented, franchise restaurants, but that was the first time that I really started to understand, the value of a franchise and the relationship between a franchisee and the franchisor. And I ended up then going to work for that lender in a credit capacity. I started out as a credit analyst and ended up, being their chief credit officer. But that was kind of my entry into the franchise space. And then, for the next 15 years, I, worked for a handful of different lenders, originating franchise loans. We started off in the restaurant space, did QSR, family dining, fine dining, expanded that into other franchises like the Quick Lubes, like Jiffy Lube, and then even kind of dabbled a little bit in the convenience store space. But it was during that time that obviously when you're making a loan to those types of businesses, you're reviewing financial statements and tax returns. You start to understand the economics of these businesses. And it was really, it was interesting to see, people that started with one location, growing to multiple locations, how successful people can be being a franchisee of some of these brands, well-known brands.
Yeah, I mean, that was incredible experience because you were able to really get under the hood of
Yeah,
so many different brands and operating styles simultaneously, right?
right.
On the credit side.
Yeah, I
Phenomenal.
mean, you learn like what their labor margins should be, or what their food and paper margins should be, what EBITDA margins should these businesses be generating, and we use that to determine whether or not franchisees were a good credit to lend money to, and so Yeah, it was a fun time. Securitized lending was the choice of lenders in the early 90s. Banks weren't really interested in making loans to restaurants. Then it kind of morphed into specialty finance companies like GE Capital, and then a lot of the big money center banks got into the franchise space, and that's predominantly, I think, who are the most active today are banks. Though there are some specialty finance companies out there that are still active, but much bigger market for borrowing than there was in the early 90s. So, which tells you something about franchising as well. It's gotten a lot of attention from lenders because I think you can make safe loans to a franchise business, under certain parameters. So yeah,
Okay.
I mean it was an incredible time in my career. I got exposed to a bunch of different franchises outside the restaurant space, and in 2007, I really kind of wanted to be on the other side of the table. I wanted to work for an operator, and the most logical transition was to a CFO position with a franchisee. And my first CFO job was with a true family-owned Sonic franchisee that located here in Phoenix. It was a husband and wife, and their two kids were involved in the business. And they had 32 stores.
Wow.
Never had a CFO before. Were outsourcing their accounting, wanted to bring their accounting in-house. So it was a great first CFO position for me. I've learned a ton, and it really kind of set me up for the positions and the roles that I was able to get after my time with that company ended. So I worked for that company for 7 years or so, and then took a CFO position with a large KFC franchisee, and help them kind of straighten some things out from an accounting and finance perspective, and then help them in exiting their investment, which was my first that was my first transaction on the operator side, M&A transaction, and so learned a lot during that period, but successfully exited that business for them.
Wow.
And then I went to work for a large Pizza Hut franchisee, and kind of similar experience. Came in, helped them kind of correct some things from a finance and accounting perspective, and ultimately helped that franchisee sell his 300 Pizza Huts via three separate M&A transactions, and
Wow.
had a successful exit there as well.
Let's pause here for a second because
Sure.
we're keeping track. I'm sure the audience is keeping track. You got a one CFO position at Sonic, then another one at KFC, which exited, and then the Pizza Hut. So let's
Mhm.
talk about the KFC. Was that a transfer to another operator, or was that just an exit where private equity or any
Yeah.
large group stepped in?
Yeah. We sold the Pizza Huts to KBB Foods, which is a large KFC franchisee. They're in other brands now, but um, I think that was a logical choice. KBP was looking to expand their footprint in KFC. They're known as a very good operator, so that was a pretty simple transaction. There wasn't a lot of having to go out and court buyers. We were selling at a time when KFC was doing exceptionally well. So timing is everything when it comes to selling your business.
Good multiples.
Yeah, and we got a multiple of EBITDA that was attractive, and so yeah, it was a fairly smooth transaction. The one thing it did, because it was a large transaction, it was over 100 locations, and it taught me a lot about like some of the complexities when you're selling a franchise business. And one of the areas is when you're handling or trying to get the assignment of leases from your company to the buyer, that can be one of the pain points in an M&A transaction. And at the time, I wasn't aware of Leasecake, but Leasecake would have been very valuable in kind of help facilitating that process. And we'll talk a little bit more here in a little bit where we did use Leasecake as part of an M&A transaction and how that impacted us, but positively. But yeah, that was kind of my first, sale where I
Mhm.
saw all the areas where, things can go wrong, not only for, the buyer, but, I mean, the seller, but also the buyer. And yeah.
What things go wrong with something as simple as consents? I know it's critical for
Yeah.
assignment. Any,
One of the things that I've learned, and this benefits both the seller and the buyer, is oftentimes a landlord, when you're trying to get them to do the assignment, um, they want to keep the seller on the lease. And in the situations that I've been in, it's been a smaller operator selling to a potentially a larger operator. So in many ways, you can argue that, the credit tenant is now stronger with the buyer buying these stores. And so, but I think what happens is, people just kind of like, maybe even think that it's a lot, there's going to be a lot more effort to try to convince the landlord not to keep the seller on. But where that comes into play is when you have changes you want to make to the leases or um, options that are on the leases. If you want to maybe extend a lease, um, you would think that the seller would not have to consent or sign off on those types of changes, but they do because they are still on the lease. And if you're making a change to anything relating to the lease, landlord wants to have the seller sign off on that, and that just becomes really kind of a hassle or a pain for the buyer. Because who knows where the seller's at? A lot of times the seller and the buyer are not staying in contact, obviously. And if the seller just totally exited the business and is no longer in franchising, you know, they're not going to be necessarily cooperative, signing off on a change on a lease on a business that they have no involvement.
sure.
So, so that's always something that I always tell people when they're selling their business is try to get or I'm sorry, on the buy side, if I'm telling buyers, try to get the seller off the lease assignments because it will make your life a lot easier down the road. And the other thing too is I think sellers don't quite understand that when they're still on the lease when it gets assigned, it's technically they're on the lease through the extensions, through the options. So, I think most sellers think that they're only on the lease through the current term. And then if a buyer exercises a lease option, that the seller somehow is off that lease extension or that option that gets exercised, and that's typically not the case. So it just extends the, I guess, liability exposure for a seller. So that's the big benefit from a seller's perspective of getting off those leases when you sell the business.
For sure. Wow. No, that's great insight. It's never clean, especially when you've got now three
Yeah,
parties. You got the landlord, you got the seller, then yourself as the buyer.
yeah. Yeah, so I mean, and leases tend to be like one of the last things that gets wrapped up when you're doing an M&A transaction because it takes the longest, especially if you're dealing with 100 locations, a deal of that size.
Yeah.
So having good legal counsel, I found is also key in these M&A transactions. So yeah, that first transaction, I learned quite a bit of the do's and don'ts of doing a sale.
Man, it's like you
So
probably have the Spencer Manke playbook, right? An M&A playbook. You just
I've got a checklist, sure, yeah, that we follow, and it's definitely helped eliminate some of the hurdles or the missteps that you can have in these M&A transactions for sure.
yeah. Well, so CFO one, two, and three on the restaurant side, and then um, I think you've got this incredible transition, right? You went into health and wellness. Uh,
Yeah,
that was keep going.
yeah. I mean, yeah, the Pizza Hut franchisee that I was working for, he was exiting Pizza Hut, and so was selling his stores off, and I helped helped him achieve those exits. And an opportunity just kind of came across with a Massage Envy franchisee here in Phoenix, which is where I live, and they were private equity backed. So this was my true like first experience with private equity. And their mandate was to go out and buy smaller 1, 2 unit operators and kind of consolidate some of the smaller operators into a bigger organization. And I came in a year after they had started, so they had already done some acquisitions, but it was really interesting. I had to learn the business. I mean, obviously, it's different in many ways from restaurants, but there's a lot of similarities. You still have a franchisee franchisor relationship. Labor is even a bigger part of the health and wellness brands. I mean, that's your big cost is your labor. And so, yeah, it was a really good transition. The PE firm that was backing the company was great to work with. Their target investments were founder-led businesses, and so Massage Envy was perfect for that because their first transaction was a founder, led franchisee of size. They had 20 plus locations. And so they started with that, and then they just added on other transactions within the territories that they had the rights to expand in. And
Nice.
we got to 100 locations at the time that I left the business. But yeah,
And we can say the name, right? It's public. I mean, was it Trivest?
Trivest was the PE firm. Yeah.
Yeah,
So, and they're still in that investment. You know, COVID obviously had a different impact on different businesses and different segments of the franchise industry. For health and wellness, especially massage, where people were putting their hands on you. COVID was not a an ideal situation, but we actually came out of that in pretty good shape. A lot of that was due to the senior leadership that we had within our company, and
hmm
we were closed for 2.5 months, but we reopened. Massage Envy is a membership based business model, so we did see people canceling memberships and so forth that weren't comfortable at the time to come in and get a massage, but that brand, has rebounded to a certain extent. And but you saw how COVID impacted restaurants. I mean, especially like QSR, some of them, some of the brands like Pizza Hut, where I'd left, COVID was actually a boon for them,
sure.
in
Yeah.
their delivery and takeout business. So
Yeah. Well, I mean, the strong get stronger if you understand what your fundamentals are, unit level economics, what
yeah,
your strengths are. I mean, sure, COVID definitely has an impact, but I mean, the company that Trivest acquired, I mean, they're a customer of ours. They continue to grow. The Massage Envies are doing
yep,
quite well. So
yep,
it's a testament to that team. And yes, you were the CFO, so you probably kept all of their books and all of their dashboards and financial visibility in good order for you to make
yeah.
your next change.
Yep. Yeah. And so from Massage Envy, I went to work for CEO that was our CEO at Massage Envy, the franchisee. He
Yeah.
had left to take another opportunity with a European Wax Center franchisee. And so I ultimately went to go work for him. And so I've been with European Wax Center not quite 2 years. Very similar business to the massage business. I mean, it's when you compare it to like restaurants, I mean, restaurants are very much transactional. I mean, there's some relationship building there. I mean, provide good service to your customers. They're gonna, you have a good chance of them coming back. But in the health and wellness, it's all about the relationships with your guests. And
Yeah.
so, at EWC, that's very, similar to Massage Envy. And you know, again, labor is the biggest component of our business. And so we spend a lot of time from a finance standpoint looking at better ways to make our labor more efficient. And so, one of the things, that's obviously, kind of been sprung upon us here in the last year is the whole influx of AI solutions. And for a business like EWC, we're looking at AI to help us, schedule our employees more efficiently.
Mm.
Because when your activity is based on appointments, that guests are making, there's a possibility that you have people that are just standing around that aren't, they're waiting for walk-in guests to come in. And so, we're looking at every way possible to maximize the efficiency of our employees, and we're looking at some AI tools that are going to help us from a scheduling standpoint. And so,
Fantastic.
and I know that that's also occurring on the restaurant side too, because again, labor is a big component. Labor is not getting any cheaper, and you can only pass on so much to your customer in terms of the increase of those types of costs.
Mm.
So, yeah,
What?
it's an interesting time right now to be a CFO, really. So.
Oh my God. Yeah, for no, for sure. I mean, you've seen it all, and there's still more stories to tell. Let's talk about the business model of EWC Massage Envy. Is EWC membership based as well?
It's not a membership-based model. We sell packages of waxing services. So if a guest comes in and gets their underarms and their lip waxed, that's what they do. We'll sell them a package that will cover like 9 visits. So they're prepaying for 9 visits.
Got it.
And the incentive is that they actually get 12 visits for the cost of 9. So we have these promo periods during the year. We just finished one. May and June is a promo period where that's a clear incentive for people to buy a package because they're essentially getting 25% off the
Yeah,
the rack rate cost of getting those services performed.
for
But
sure.
but yeah, it's not a membership base. So the lifeline for our business is selling those wax passes because that encourages rebooking, them coming back and getting services, and it gives us the opportunity to add on services or sell them retail. So
Okay.
that's the backbone of our business.
Sure. So let's do a compare and contrast. This question came in from Chris, so thank you, Chris, for this question, which is, what do you see, Spencer, as it relates to membership models like at Massage Envy? Are you seeing any, any changes in membership models? I know that's not what EWC is.
Yeah.
Prediction.
Well, so I mean, you've got two membership models. Like your gym membership, it's a use it or lose it, right? So if you're a member at Planet Fitness, you pay a monthly fee, and if you don't use it, you paid for it, but that fee you paid covered a month that you had access to the gym. With Massage Envy, you're paying for a service. You get a credit for a service. So if you pay your monthly membership dues for a given month and don't use or don't go in to get a massage, that massage is a credit on your account. And that rolls forward as long as you continue to pay your membership dues. So one of the challenging parts about that type of model is you're building a liability on your balance sheet for all these unused credits. And so obviously, from a business standpoint, you like the fact that you're collecting your membership dues. And for those people that don't come in and use them every month, then you're not seeing the expense side of the transaction, right? Because they're not coming in to get a service, so you're not paying a masseuse, or you're not using any of the raw materials to perform the service. But that liability continues to build on your balance sheet, and so that's one of the differences between like Massage Envy and Planet Fitness. And so managing that liability becomes important because you don't want somebody building up 10, 20 credits. And then, all of a sudden they want to come in and use a lot of those credits, like say within a given month, because more than likely they won't be able to do that, depending on the availability of your masseuses and or your massage therapists and their hours that are available. A lot of times people are booking out their appointments months in advance. So if you're trying to come in and use multiple credits in the month, that can be challenging depending on how many massage therapists you have on staff.
Got it. Got it.
So,
Well, so let's stay with EWC Growth Partners. When you joined, how many units did they have, and then kind of where are you today?
yeah, we were 44 locations, I think, when I joined. We're sitting at 52 right now. Um, Initially the company grew through acquisitions. We have territories where we have development agreements. So, if operators, other operators in those markets, if they are looking to sell their locations, more times than not, we're the most logical buyer in those situations. We've been spending the last 2 years building out stores. Not acquiring locations. And that's been interesting. I mean, obviously, this cost of materials has been a challenge.
Oh,
It was at one point 350 to 375 was the cost to open up an inline European Wax Center. Now it's 475 to 525.
wow.
And so that impacts your ability to recoup your investment, your payback period.
That's what, like a 30% jump? I'm just trying to keep track.
Yeah.
Jeez.
Yeah, roughly 33% jump. And that's material. I mean, that's significant. And so what we're finding is, and let me step back a second. With EW, the difference between a European Wax Center and say a restaurant brand, usually with a restaurant brand, you're building excitement. Hey, a new store is being opened, you get this pent up demand, and you tend to, the first several months you're just taking off, right? And then they kind of levels off. With a European Wax Center and with a Massage Envy as well, you're building your book of business. So it takes a while for you to get to that break even level or to a level that you expected in terms of profitability. And so we're kind of in a position now where we're actually looking at M&A more than we are in developing new locations, just because you're buying existing cash flow. You kind of know what you're getting already,
Mhm.
and with the multiples that we think that we can get on some of these acquisitions, it's a better return on investment right now than building a location.
Oh, for sure. I mean,
Yeah,
my gosh, and whether there's this theme of consolidation and these smaller operators want to either they can't pass their legacy to their kids, for example, but they're looking for an out at at a
yeah,
reasonable bit. The economics just completely make sense for you
yeah,
to come in and acquire them. So,
yeah.
this question came in as well. So thanks for this. It's like, how do you what do you suggest in terms of I guess the key drivers for keeping your books clean
Yeah.
for M&A, like as a seller, your advice to them to say, hey, listen, we're EWC Growth Partners. The way that we look at you is this, follow this. What would you recommend?
Yeah, I mean, obviously this is going to depend on the size of franchisee, but to the extent that you're large enough and it makes sense for you to be on an accounting ERP system like Sage or NetSuite or Microsoft Dynamics, Great Plains, having a little bit more robust accounting system, I think is viewed as a positive when a buyer is looking at you, especially a PE buyer. They want to have confidence in the numbers that you're presenting to them. And so having an accounting system that is well put together, is simple to follow. That's kind of the other thing too, is like, this is kind of an offshoot to the question, but when you're thinking about how you're organizing your business, you want to do it in a way that is simple for people to follow. I think the typical structure is you've got a holding company, and then you can either separately incorporate your locations or not. But that translates into also then how easy it is to get information out of your ERP system. So having an ERP system where if you have multiple entities, it can consolidate it into one entity so you can see what the whole company looks like financially.
Mhm.
I know QuickBooks is a typical accounting ERP for small businesses, but QuickBooks has its limitations, especially if you have multiple entities being able to consolidate things. I've done a couple transitions from QuickBooks to Sage or Microsoft Dynamics, and so I think your ERP system is number one. Having your leases in order, and again, a plug for Leasecake here. A software, or an app like Leasecake is invaluable. in some of the acquisitions that I did later in my restaurant CFO career, we simply just gave the buyer viewable access to Leasecake and said, go in there and start reviewing the leases. So having your data, your information, in a concise, manner, whether it's using an app like Leasecake or something similar, I mean, that's important. Um, not always is a buyer looking to take on like your back office functions, like your accounting, finance, HR, and IT. But if you're a business of size, and if you're looking to attract PE partners, having a well built out back office becomes important.
Yeah.
Um, some PE firms just want to buy the assets and then they're going to build the back office themselves. But some, are attracted to the fact that you have a back office that's, well, fine-tuned to, can generate financials, within a short period of time after a month closes. Because what they will do is they'll view that as, okay, we can grow this business with this back office that's already in place. But PE firms are also looking at, hey, if we wanted to get into a second or a third brand, do we have the back office in place that can handle that? Or, is it a foundation that we can grow on so that we can accommodate, operating multiple brands, in addition to the one that they're initially making their investment in?
Yeah. So you've touched on, I think, really three important themes. One is get yourself organized well in advance, back office, having systems that not only helping you run your business day to day,
Yeah,
but be more attractive to a PE firm or any buyer, anyone that's looking to acquire your locations. Because number one is not only gives you confidence, gives that buyer confidence in the systems, but also
yeah,
gives confidence in you, right?
yeah,
Because man, the management team thinks seriously about the technology and the components that help them run the business. And in the race to get a clean, smart, fast deal, whether it's a lender or PE or any buyer, they've got all these different deals in their pipeline that they're
yeah,
looking. And the one that's the most organized, the one that's got all their systems in place, chances are their resources can be pointed to them first, to you first, rather than the other folks that are in your pipeline. So confidence in the team, and then
yeah,
I mean, you definitely touched on it, which is when you have a standard solution that allows you to scale, that PE firm or that buyer may not have a system, but you can start to say this system that we have that you're now acquiring can reinforce the scale. And
yeah,
so, standard systems are good.
yeah,
Uh, so I don't
yeah,
know. I mean, the third one's kind of buried in there somewhere, but it's like those are really
yeah.
themes.
Yeah, a PE firm, I don't think wants to step in and have to fix things, right? They want to step in, make it their initial investment, have a really good solid platform in place, and they want to hit the ground running, right? I mean, they want to be in the M&A mode, looking to buy other operators in the same brand. Their goal is to get to scale as fast as they can.
Yeah.
That's how value is created, and yeah, so the more organized you are, and utilizing some technology, I think again, I think is viewed as being attractive by PE firms.
For sure, for sure. Clean, smart, fast deals. Everybody wins. Yeah.
Yeah, yeah, and
Um,
I think and from a seller standpoint, I think you can inherently command a higher multiple when your business is tight and you're able to provide information fairly easily. It's not a heavy lift for you to generate P&Ls for a buyer. I think again, I think you can take that advantage of that if you're a seller, and treat that as a way to add a premium to your the multiple.
no, I'm glad you brought that up, and we're hearing that time and again where it's protect your multiple or juice it because you do have systems in place, and it's absolutely can be validated because you're growing faster, you're opening quicker. Um, the other part of it is Gosh, hang on. I just lost a thread. Like this is this is like super cool stuff. Anyway, let's keep going. There's a question that
Sure.
just came in from James. Thank you for the question, which is with regards to bringing in like the timing to bring in someone of your caliber. I don't know. James can probably elaborate further, but at what point in
Sure.
time, you got 24 locations, Mathnasium in this specific instance. What are the recommendations? What are the things that you'd consider to say, let's bring in someone like a CFO?
Yeah, I mean, I think it really depends on the brand, the complexity of the business, and really, what are you trying to achieve by bringing in a CFO? I mean, a lot of times the founder is the president, the CFO, and probably the COO as well. The person's wearing many hats, right? But if your goal is to grow, maybe aggressively grow, it's hard for one person to wear those multiple hats, and then you really do need somebody to be the gatekeeper for the not just the accounting side of the business, but the financial side. Somebody that can come in, help you go out and obtain the capital that you need to grow.
Hmm. Hmm.
Whether it's debt or equity.
Yeah.
Uh, so it really depends on where you're at in your business. I mean, if you're a 25 unit operator and all you want to be is 25 unit operator, and you're able to handle the different responsibilities as the founder of the company, unless you're wanting to work less, and not be working as much, that's probably not a business that it makes sense to bring on a CFO. But um, so yeah, it kind of depends. To me, I think the sweet spot, for the brands that I've been in, is probably, you start thinking about it when you're at 30 locations. Yeah.
Yeah. Yeah.
And you know, the other thing too is, I think, you were talking about, like, when you're selling a business, what do you need to have kind of in place when before you go out and start marketing the business? And whether it's PE or if it's just another, private entity that's going to buy your business, and maybe that is interested in your back office, having really good qualified people sitting in your controller positions, a little bit less so in your senior accountant positions, but if they've got experience in franchise accounting, that's a plus. But that I have found the controller position to be invaluable. And I'll give you an example. With my current position at European Wax Center, when I came on board, our controller had already given notice he was going to move on. And so I reached out to somebody that I had worked with before. And, for us, geography is not an issue. We don't have a corporate office per se. All of our people are remote, and we're running a $50 million business with having all my accounting staff is all remote. I was looking for the best controller out there. That was more important to me than that person physically being here in Phoenix where I reside. And so and that was the best move I could have made. So I spend less time dealing with some of the minutia on the accounting side, and I can spend more time on the strategic direction of the business. I spend more time working with the CEO of our company, figuring out, okay, what's the next thing we need to address, or what can we do to squeeze out some more EBITDA from our sales dollars. So building your team is also very important.
Absolutely. And there was a question that had come in that we answered, but the other part of it is the question about middle management. What do I need to look for despite the fact that I've got middle management? Don't be afraid of middle management. Make sure you always hire the best.
Yeah,
Be engaged in different shows, events, network. Always be looking for top talent because
yeah.
within the controllership and the finance roles, I mean, it's worth their weight in gold. I used to be a CPA way back in the day until I figured out like there's this is a lot more fun,
Yeah.
but I would say uh, tied to when are you ready to hire a CFO, there's also an argument to say, take a look at fractional CFOs. I mean, what are your thoughts on that?
Yeah, I mean, I've got an FP&A person that is, not a W-2 employee. He's a 1099, but he had worked for us and then went off and is doing something different. But I don't need a full-time FP&A person. So he probably does 10 hours a week for me, and it works out great. He understands the business, and I'm not having to carry a full-time person on my payroll.
Right.
For CFOs, I think the fractional is absolutely a good option. There are a lot of good CFO, fractional CFO firms out there.
Mhm.
And it may be that you just need somebody to review financials at the end of the month, or help you raise debt, or be part of like strategic decisions of your business. um, Fractional CFO would be a very good option for that.
Yeah, and you can grow into bringing that person on board full time, because in any transaction they'll want to say who's on the team, right? You've got
Yeah,
across the table. This is the team. I'm the owner, the operator, the CFO,
yeah,
the folks that are really keeping the system running. And
yep,
with your 50 plus EWCs, you got to make sure that you convince the buyer that we've got a really solid team. And then
yeah,
when the fractional CFO, elevates and you're comfortable with that person, then, maybe they belong in your team as you grow.
sure,
So Dara,
sure.
thank you for that question. That was awesome. We're gonna flip just for a second on the
Okay.
QSR side, QSR acquisitions. What are the tools and resources for a QSR that is potentially looking to exit?
Yeah, I mean,
Touched on it before, right? With
yeah, so like with the Pizza Hut franchisee that I was with, I mean, we hired a small boutique investment bank to help us go out and identify buyers. So they were more than just a broker, a business broker. I think there's business brokers out there that will put together an offering memorandum, that highlights your business, and then they sit back and wait for potential buyers to come. Depending on what brand you're in, you may need a little bit more than that. And so there are some you know like I call them boutique investment bank firms out there that do a great job of marketing. They've got the Rolodex of potential buyers, and a lot of times it's they're going to clients of theirs that they've done work for in the past and say, hey, here's an add-on opportunity for you to pick up this QSR brand on this transaction. But if it feels overwhelming to you, just the process of selling your business, and again, it depends on the size, right? If you got one or two stores, that's a little bit different. But if you got 25, 30 store, business that you're looking to sell, don't be afraid to get some expertise. There's a cost to that, but I totally believe in the adage that you're probably going to get more on a multiple by using some outside assistance to help you, versus if you go alone by yourself. So that additional fraction of a multiple of EBITDA that you got for the business will essentially pay for that advisor that you have to
Yeah.
pay.
Yep.
So and it's going to be far less stressful for you as a seller.
Yeah.
So
And I think tied to those systems are, what you could call EBITDA savings, because if you're growing, you want to make sure you have a lean team all
yeah,
wearing multiple hats. And
yeah,
when you invest in the right technology, it means you can avoid or delay hiring key people because you can do more with less. So
yeah,
it's like there's an EBITDA layer which can drive that valuation multiple. That
yeah,
it's like, holy cow, it's saving me 100 grand or 200 grand because I don't have to hire the people
yeah.
until we really need it as we grow.
Yeah. So, in my experience, when we've sold groups of locations, we typically are only showing a buyer store level EBITDA. So we're carving out the G&A component. And the reason for that is, your G&A may not be the same G&A that a buyer is going to incur when they pick up your stores. They're probably going to be spreading the G&A just further across, a network of stores by picking up your locations. And so, you don't want G&A to become a part of a big part of the negotiating process. So of course they're going to ask to see what you incur from a G&A standpoint, and that's where I think being organized too it really helps. And this happened with the Pizza Hut franchisee that I worked for. He was also a Panera franchisee, and I helped him sell his, I think he had twelve locations. But, the way we presented it, we didn't, we initially just showed store level EBITDA, and then they obviously wanted to know, okay, what is G&A? And really, in an acquisition setting, what a buyer should be concerned about is, what is more like the ops G&A, right? So, do you have a chief operating officer? Do you have area managers or district managers? What does your org structure look like? Because that's the decision they're going to be making as a buyer. Like, do I need those people? Do I already have a COO? So
Yeah.
I don't necessarily need a COO, but I need those area directors. Are they overseeing enough stores, or are they overseeing too many stores?
Yeah. Yeah.
That's the G&A component that I think tends to be discussed as part of M&A. But you know, I'm always careful in showing the G&A, because again, if you're a smaller operator selling to a bigger operator, your G&A load may look different, higher than what it's really going to be for the buyer, and you shouldn't be penalized for that as a
Yeah,
seller.
right. Right. That's where a Q of E comes into play. Um, so with we talk a lot about the organization and growth. We've been endorsed by large cap, mid and small cap PE firms.
Mhm.
So if anyone that's listening either today or in the future, we have a great connection and network of transaction advisors. You talked to Spencer about boutique transaction advisors, even our customers that are in all sorts of senior leadership roles. If there's any advice that you're looking for, feel free to ping me directly, after this, Taj at leasecake.com. Happy to help and connect you. So I'm just offering that as some guidance and advice, because these are great questions. I mean, Kristen, you asked a question about right sizing your company as you're growing from 10 to 30 and 50 to 100. I don't think there's necessarily any magic formula. It really depends what industry you're in and
Yeah,
how strong your supporting team is to build
yeah.
the COO and the like.
Yeah, I mean, in my CFO positions, I tried to be as involved as possible, with what the operation side is doing. And so, a lot of, and some CFOs don't do that, or some companies don't want their CFOs doing that. To me, I found it to be beneficial, because a lot of what I'm doing on the finance side depends on my understanding of what's going on the ops side. And so, talking about how you incrementally grow your business and your staffing, the biggest thing that I've seen is, operators that try to save a few bucks on that second level of ops management, like your district managers or your area managers, where there's just too many locations that one person is overseeing.
Right.
And sure, you're saving some money, but that's really a short kind of sighted approach. You really need those area managers to be in their locations as much as possible. And if they're responsible for too many stores, they're not getting that
Yeah.
frequent touch base with the locations.
And they should also be multidisciplinary. So not just hiring for one specific skill set, but if they're in
Yeah,
charge of store operations, put them on the front desk, put them in the back,
yeah,
expose them so you can find out where their strengths lie
yeah.
and where their natural talents pull them, because then that's a great path for them to be promoted in
Yeah,
leadership.
and one of the other things that I've seen kind of change just over my career, it used to be, hey, the best thing to do would be promote from within, right? For more, responsible positions. That's not always the best thing. I found that, specifically on the Massage Envy and European Wax businesses, where, when you promote a manager to being an area manager, that is such a huge jump um, in skill set that in more times than not, you're better off going out and getting somebody that maybe doesn't have your brand experience, but has that multi-unit management experience. You're going to have a better
Yeah.
uh, result in
Yeah.
buying in going outside the company to look for that skill set.
Sure. Well, then let's go into some key KPIs like rent to revenue ratio. I mean, what do you typically track, and how do you look to optimize something as basic as that?
Yeah, again, that's going to depend on the brands, obviously, too. But I mean, the general rule of thumb.
Okay.
Yeah, the general rule of thumb, I mean, just in franchising when I was on the restaurant side is, if you could keep it below 7% of revenue, you're probably okay, right? But I've seen people that do a phenomenal job in negotiating their leases. I was talking to a Wingstop franchisee and they've got, multi-unit. I mean, their rent as a percentage of revenue is like 3.5, 4%. Now obviously that has a lot to do with the fact that that brand is mostly inline locations, right? The same goes for like EWC. We try to our spaces are really small. It's really kind of amazing, how a business can be in such a small footprint. I mean, our average size location is 1,000 square feet, compared to most QSRs I think are 2,500, 3,000 square feet. So rent, should be less of revenue for our type of business, unless you're choosing to be like in the A plus, retail areas of your market, then you could be paying 7% or higher. But it may make sense to do that, if you're talking about, having a significantly higher top line. Uh,
Mm.
the one thing that I always tell people, and I think this is not as common anymore, in our businesses, is I absolutely will not sign a lease that's got a percentage of revenue kicker for the landlord. To me, that makes no sense. I mean, you're already paying your base rent for the value of the location. I mean, the landlord's not doing anything to help you increase your revenue in most cases. So giving them a percentage of revenue to me
Yeah.
it doesn't make sense in today's business.
Yep.
So.
Yep. All right. So let's talk about we're coming up on time. We got about 5, 6 minutes left, and we've got some more questions. As it relates to kind of common mistakes, what have you seen, whether CFOs or leadership have made in scaling operations? Anything you can share?
In scaling operations, to me that most of the mistakes have been just hiring decisions. Maybe making too quick of hiring decisions. You know, the successes that I've had is when, it's not just, if you're hiring for a position, get some of the other senior leadership to be a part of that process, because they may have perceptions of somebody that's different than what you're seeing. And I'll give you an example. We were hiring a facilities director that oversaw, all of our facilities for our EWC business. And we had three candidates that were really solid. And I had ranked my three candidates. And the person we ended up hiring was actually the third person on my list, even though this person was reporting to me. And it was because I had other people that had different insights, and we made the best hire, right? So I'm not saying that if we would have hired the person I had number one on my list, that it would have turned out bad, but I think the cost of making a bad hire can be pretty extensive. It can be really disruptive to your business. So, have very well thought out, job descriptions, make it a multi-step interview process. But so hiring is, I think one mistake when people are building their business. Trying to think of some of the other ones. I mean, we haven't talked about capital structure. Again, capital structure of your business I mean, I can't emphasize how the importance of it. It's really important. It used to be in the days like, when I first started on commercial lending, franchisees wanted as much debt as they could possibly get, right? I don't think that's the case nowadays. I think people understand more about leverage. And so when you're growing your business, just you may have really big aspirations on how big you want to be, but have a really well thought out capital plan as to how you're going to get to that size.
Yes.
And it's going to require you to put some equity in the business. And if you don't have the equity, then maybe bring in a partner that does. But managing your capital structure is huge because if you're in a good position from a capital structure, you're going to be better off kind of weathering any downturns in the economy uh,
Hmm.
versus if you're just leveraged to the eyeballs. I mean, any disruption in your business is probably going to put you in a very precarious position.
Well, so last question here. From a private equity perspective, where you guys are headed, let's talk about due diligence and give me, your sense of preparing for due diligence. How important is it? Let's kind of wrap up with that as a theme.
If I'm an operator and a PE firm is looking at buying my business or investing in my business, right? PE firms, I mean, PE firms will, not always buy 100% of your business. They may buy a controlling interest, 51%. Because depending on the situation, they may want the CEO of their initial acquisition to be involved in the business and help grow it. So having that CEO still have some equity on the table in the business, it will make sense. But again, I think it goes back to a lot of the things that we're talking about. And it's making sure that everything that a PE firm is going to look at your financials, policies and procedures, having SOPs, standard operating procedures for things, outside of the accounting and finance department, obviously too, whether it's IT or facilities or HR. I mean, just looking like a professional organization. That's what PE firms are looking for, and I think more and equally important is hopefully you're in a situation where either you still have development agreements or you know for a fact that the franchisor has approved you for growth, whether it's through new unit development or acquisition. That is a key component too, because there will be a point where a PE firm may exhaust all the M&A opportunities, and then they're going to you're going to want to go back and like infill some of your markets with new locations, ground up greenfield development.
Real estate matters, due diligence matters, getting yourself
Yep.
organized. We always talk about the best time to plant a tree, right? It's 20 years ago or today. The best
Yeah.
time to prepare for due diligence is 20 years ago or today, because a transaction can manifest itself in so many ways. And, we're all looking for what's my plan to pass the baton, who's going to
Yep.
take over, how do I, extract some wealth out of what I've created.
Yep.
Well, man, Spencer, you have been a fantastic guest and imparting, incredible wisdom,
I
5 times
appreciate it.
CEO with such vast experience. I mean, even your previous lending experience. Wow. If anyone needs to get in touch with Spencer, obviously you know how to get in touch with us here at Leasecake. Feel free to drop us a note. We continue to have Leasecake Live webinar series, very educational, and we've got several coming up, so stay tuned. Thank you so much, Spencer.
Thank you, Taj. Appreciate it. Enjoyed it.
Thank you, everybody. Bye-bye.